It seems to be a change in tone from 6 months ago when you last reported. Everything then appeared to be on the mend, but now you're seeming a little bit more cautious. What's changed since then?
I think really what we saw happen in March, April is a significant slowdown in Europe off the back of the sovereign debt crisis there. And you'll know that many of the South African manufacturers export into Europe. So I think what we're likely to see is a tougher second half from a wholesale asset growth perspective than we would have envisaged in March of this year.
How about the retail customer? How are they looking at the moment?
So we certainly think that the worst is behind us, and it's very pleasing to be able to report the first drop in our impairments charge period on period for a while. But what we know is that the South African consumer still remains very highly indebted, with debt to disposable income levels at around 78 to 80%. So we do think that although things are getting better, they are likely to improve slowly from this point.
So a drop in impairment levels, but still remaining quite high though?
Yes, our overall credit loss ratio, or how much do we lose for every 100 Rand we lend out, sat at 1.4%. And our normalized number for that is somewhere between 60 basis points and 100. So if you cut that in the middle at 80 basis points, there's still some way to go before we're at more normalized bad debt levels.
About 6 months ago, when the banks were last reporting, many of them, I think yourselves included, were talking about the retail customers starting to get back on their feet. The problem then was, or the concern then was, perhaps the corporate customer. How's the corporate customer come through this so far?
So I think the corporate customer has still come through the cycle in total in remarkably good shape. We have seen a slight uptick in the bad debt charge in our investment bank, primarily on some shareholder loans in our private equity portfolios. But corporate South Africa, from a credit perspective, is still in good shape.
Assets not really growing in the banking sector. I think you showed a little bit of growth in your assets over the period. Is there still no appetite from consumers and businesses, or is the bank still being a bit too cautious, Mike?
I think we were pleased. We grew our assets around 5% and were able to pick up market share, in fact, in most categories. I think it's a bit of a double-edged sword. Certainly the consumers are still remaining cautious, and it is probable that people will use extra earnings at this point in the cycle to repair balance sheets rather than to invest and grow. And I think on the corporate side, you saw the PMI numbers out this morning. I think corporate South Africa is still cautious about the medium-term outlook for the economy.
Where are you growing your market share at this stage?
So we've grown in pretty much every category except residential mortgages, where we lost about 30 basis points over the last while. With specific growth in some of our unsecured products. We saw good growth in our personal loans business and in our card business.
Mm-hmm. Interest rates coming down, that's great for customers. Double-edged sword for you though, because it's good for customers, so you perhaps have lower impairments, but at the same time the endowment effect eats into your margins, doesn't it?
That's exactly right. We think of it at this point in the cycle as short-term pain for long-term gain. So the overall effect is still positive, but a hurt to near-term earnings from the endowment effect, and then better earnings further on in the cycle from higher asset growth levels and lower bad debts.
Would you mind taking a little bit more short-term pain with perhaps another interest rate cut? Because we've had some banks, particularly Investec recently, saying that we should have had that interest rate cut at the last MPC. Do you think another interest rate cut is justified? Do you think it would help your business going forward?
So we think that the MPC did the right thing at the last meeting. We were forecasting rates to remain flat. I think we'll have to watch very carefully as the data emerges between now and September. But the risk certainly is to the downside for rates. And we'd be very happy to take the short-term pain for the longer-term gain, because the present value effect of all of that together is in fact net positive for our shareholders.
You've had quite a focus on growing your non-interest income. That's growing quite handsomely, I think 15.7%. Comparable non-interest revenue up 7.8%. Is that going to continue to be a focus, or are you going to shift away from a focus on growing your interest revenue?
Yeah, I think that's right. I think if you look at Nedbank as a franchise, we have extremely strong franchises in the assets and liabilities department, but right across our wholesale and retail businesses, we've been weaker on transactional banking, and it remains a key focus area of ours to improve our transactional franchises.
As you've been growing your market share, has it been good market share you're growing? Because of course we have all these regulatory changes coming in globally. We've got the acts in the United States. We have Basel III. I think that's been watered down a little bit, or pushed back for the time being. But that must obviously still be a focus of yours going forward.
I think that's right. I think the challenges at this point in the cycle are both economic, with a very difficult and fragile recovery, as well as regulatory, where people are uncertain as to where the final regulations will settle. But we certainly think that the market share that we have picked up in the last year will be good market share, because generally speaking, banks write their best assets at the worst time in the cycle.
Of course, and the opposite also holds true, doesn't it? And you seem cautious about the second 6 months. Of course, the second 6 months last year was quite a low base. So all things being equal, where would you expect to be by year end?
Well, I think what we've said is that we have a medium-term target for diluted headline earnings per share growth of GDP plus CPI plus 5. So that's probably somewhere between 12 and 13%. And we've said that we think it will be challenging for us to meet that. So we'd expect some improvement in the second half, but tough to get to our medium-term targets.
Of course, everybody likes certainty, and there has been some uncertainty, particularly regarding your shareholding. Ongoing talk about Standard Chartered, HSBC, perhaps talking to Old Mutual about buying that stake in Nedbank. This does create uncertainty, I'm sure, amongst customers as well. Is Old Mutual a long-term holder of Nedbank? What are they telling you? Because this must be something you discuss with them.
I think it's really a question for them and not for us. It's been speculation, in fact, for at least 6 years about Old Mutual's long-term intentions with the Nedbank shareholding. I think from an internal perspective, we run the bank very much on business as usual. If Old Mutual decide to continue to hold their shares in us, that will be fantastic. If they ever did decide to sell their shares and they sold them to a large international bank, I think there'd be enormous benefits for Nedbank and its customer base as well.